Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a company valuation expert in St. Louis, Missouri. I have the privilege of discussing venture capital and startup company valuations today with Lorenzo Carver, a valuation expert in Boulder, Colorado. There are a couple times when we need an actual valuation. And so can you tell us a little bit more about like what is a 409A valuation, which I think
Definitely.
most startup people know that term,
Right.
but like when do they actually need it is the question.
They need it when they start issuing stock after they got financing typically.
Okay.
So historically what happens now is when you issue founder stock, a lot of times it's valued at par value, which is effectively saying it's worth nothing.
Right.
Which is not unreasonable, So whatever the par value could be 0.001 per share. So yeah, it ends up being like $1, $100 or something. That's not significant to anybody. Back, I think it was, I'm going to say around 2005-ish, 2006. There was this weird thing they did with the tax law where they thought they were like going to somehow recover money from people's stock options or something. And they came up with 409A. So to basically do that, which is ridiculous. It's more applicable to larger companies, frankly, where they were doing like some crazy stuff with stock options. I mean, when I say crazy, I don't want to say illegal because I'm not a lawyer, but it seemed illegal. I mean, to me, you're publicly traded, you backdate your options. I mean, you deal in litigation. I mean, but
doesn't seem like a great idea.
No,
right.
But like with the right lawyer, they all got away with it, So there's a lot of it going on.
And a lot of it was they created this 409A valuation process, I guess, because you would also want to get people involved and you would instead of because you didn't have any money to pay them, right? And so, but you needed a CFO or you needed a CEO and you were like, hey, why don't I give you some stock in exchange for that's your compensation kind of thing.
And they had standards for that. That went on for years. And frankly, going back to the Intel example, I mean, this was a lot of the reasons why tech companies were able to attract engineers that otherwise would be working for large companies because those large companies were given any stock to employees. The only people getting stock were at the C level. So executives that typically weren't from a technical background, largely from a managerial background. So basically, they were basically like kind of dictators. And so like the people actually like cranking this stuff out were not getting a piece of the pie. And so it was a great tool for people to attract that talent to say, hey, you're going to have a piece of the company. Even though statistically, most of those companies, they're never going to survive. But some of them, it's going to be like a windfall of windfalls and pay for great grandchildren to go to really good schools, drive nice cars, and whatever. So, but what they used to do is a lot of times they would just say 10% of the pricing for the preferred, and historically that's what you saw a lot of. And then some people would change it. They would be like, okay, it's 10% at this stage, then later stage is maybe 30%, 25%, but typically it used to be like 10%. You'd always see 10%. And if you go back to old filings and look at them, you do the math, it's usually 10%. So that's what it was. So the other thing that coincided with the tax law changes was what was called at the time FAS 123 or FAS 123R. You may have heard of it. So, but basically it was saying, and this goes back to like this whole concept of, oh, we got more companies that are public now where all these employees have stock options and there's no expense. So aren't you giving up some value by giving them these shares? Shouldn't that be reflected on the income statement?
Right.
I'm not arguing either way, frankly. I mean, I think financial accounting is such a mess now. Like, seriously, nobody read the freaking financial statements 20 years ago.
Right.
Now they're like 10 times as long. The actual bankers on the deals do not read them. The analysts don't even read the whole financials. I mean, it's that big that no one, it's not approachable. So, but they've added all this fair value stuff, so it's there. But the objective was to get a more kind of fair way of presenting it. because yes, you gave something up, right? And what you gave up would not be reflected in the financial statements until you're generating positive earnings. Now, some of that is like kind of a catch-22 because the only reason it's like that is because the accounting rules, which said we don't include those shares, right? Because if you include those shares, then all of a sudden earnings per share actually doesn't go down by as much, you know?
Right.
So they basically applied really some primitive options pricing methodology, and said, okay, we want you to capture this cost. And they did it kind of incrementally. But when they went like kind of full throttle on it, it's right around the time that the 409A stuff happened.